Good morning. It's the Oak Bloke here, and it's 10 days since I last released a video. So this is going to be MPAC. So this article, which hasn't been released yet to my Substack, is MPAC. So MPAC is a capital equipment, robotics, materials handling company. So I ask the question: do buy, or don't buy? Alas, poor Yorick, that's the question. So I start with a little bit of music. Don't worry, I'm not going to sing. You wouldn't want that. And but yeah, quite. I thought depressing lyrics, considering it was a very upbeat song. But anyway, I'll leave you to read the lyrics, and you can form your own judgment on that. Um, but that's the tune I hum whenever I see anyone talk about MPAC. Um, and it was in the news, so to speak, this week, where on Twitter I saw somebody say, "Oh, it's forming a bowl." Mr. Rebel said it's forming a bowl. Um, I don't really look for bowls, technical signals. I do a little bit look at technical signals, but I kind of I am more of the mind that the technical signals are the symptoms, or the evidence of fundamental change. So I look for the fundamentals, which then turn into technicals. Whereas I suppose technical people are looking, maybe don't look at fundamentals, but look at patterns, because the patterns reflect what's going on in the business, I guess you could say. Anyway, whichever way you look at it, and there are obviously two different ways of working out what to buy, what to sell, what's good, what's bad. Um, I mean, this is obviously not been a great share in 2025. If you bought it on the 1st of January, you would have lost close on half your money. It was one of the ideas in one of the fund runners. So I guess the question I'm also asking is, well, is now a better time to be buying it? Has the froth been blown off MPAC? Could this be the turning of the tide? I ask, and I also sort of look a little bit at what that some of the brokers have said or not said, and what their assumptions were, because clearly, this was included as an idea for 2025 because there were some broker guesses that this would hit £8 a share, and would go stratospheric. And it's not gone stratospheric. It's gone. It's dropped by about half price. So at the time I wrote this article, it was £2.90 a share. I think late yesterday it did decide to go on a little bit of a journey. So if we go and look at its current share price, let's just grab this quickly. Pack. Right, here we go. Sorry, I said I wouldn't sing. I hummed. That's not so bad. Here we go. Right. Ooh, come on. I think ever since new antivirus has been put on my computer, it's gone bananas. So if it all freezes and goes horribly wrong, there we go. So it has. You can see it's maybe this is the bowl uh, that. Oh, yeah, that's quite an edge of a bowl, isn't it? There we go. I think that's what Mr. Rebel was referring to. Um, Yeah, so it's kind of started to do one, gone back down, and started to do one. So yeah, let's get into the detail anyway of why I think on a fundamental basis this is a good idea, or not. um, so anyway, it's six businesses that deliver product assembly, materials handling, packaging systems. You can sort of see here robotics, product assembly, filling and dosing, product handling, cartoning, etc. So, and it's all around the idea that the world is becoming more automated. So one of my ideas in the Oak Bloke 25 for 25 was robotics, and I went for an ETF. And the reason I went for an ETF was, and I looked at three different ETFs. Two of them were pretend robotics and had a lot of artificial intelligence in them. In other words, were stuffed full of software companies, which wasn't what I wanted to invest in. I wanted to invest in, the arms and legs and the conveyors and the physicality of robotics, because as far as I'm concerned, there's a lot of froth within AI, and then within software, uh, and you pay you pay top dollar prices for businesses in AI. I mean, you're going to be paying 30, 40, 50 times earnings, on the and maybe more, in fact. I mean, 100 times in some cases, on the assumption that if they can double, triple, quadruple and their revenue and of course profits, that what is 100 times today becomes much less than that tomorrow. And to be fair, even RBTX, sorry, not RBTX, start again, BOTG, or BOTB, I think, is the American, the US dollar denominated version of it. Biggest holdings, Nvidia. Nvidia's on, I think, 43 times earnings. So it to buy Nvidia would cost you more than the entire GDP of the United Kingdom. So, I mean, in terms of valuations, some of the holdings were AI and software. I mean, you're not going to get 100% away from that when you invest into a robotics ETF. Um, but what you are, what I was interested in was the idea that automation and the physicality of what's going on in the world. That's, to me, a big change that's coming. And do you know what? During 2025, I think back at the end of 2024, when I chose that idea, nobody was talking about robotics. The first time I saw anyone spoke extensively about investing into various Chinese companies on the Hong Kong exchange, which some people will be happy to do, others would feel skeptical to do. In fact, I've had a bit of a change of heart about China during this year, and now some of my ideas are either physically based in China or are um, China listed companies. But in the case of China listed companies, it's Bailey Gifford, China Growth Trust. So essentially, it's a UK share, but it holds Chinese equities. And then the other one was a Canadian listed silver miner, but that has physical mines in China and a few other places that they're developing. Anyway, back to this. So I like this because it's physical and robotics, and as you can see here, these are large subsegments, and they're growing. It's very much about being engineering led. It's the case that there's a lot of IP and a lot of know-how involved in these systems. So you're not really buying a business that's going to have lots of tangible assets. You're buying a business that's got the know-how to make profitable items. And what I was particularly interested in as well was to understand gross profit and operating profit, and to look at the trends of those, and also to look at not just what the initial sale of the equipment looks like in terms of profitability, but also then look at the profitability of services. It's all the wraparound revenue, the recurring revenue. Because again, once you've got a base of these robots, think of Willy Wonka and the Charlie and the Chocolate Factory analogy. The what was it? Charlie's dad lost his job in the whatever factory he imagined in the story he worked at, but then got a job fixing the robot that kept breaking. So he ended up earning more money than when he was on the factory floor, making whatever he was making. Anyway, it might have been chocolate, I can't remember, but anyway, So let's get into the details. So there's six businesses. So Langan, Lambert, Switchback are the three that were sort of they've been part of MPAC going back years. These were three that they added during 2024. So they did go out and go on a shopping spree to buy quite a number of businesses. This one was bought for, well, they say an immaterial amount of money, so we don't know how much, but it's not material. This was a small purchase, and this was a monster purchase. So they actually diluted by about 42% to buy this. So there was obviously issue of shares, things like that, and but also took on debt. So there's both. Um, so so this one, quite difficult to see, but it's actually the clue is there. It's actually CSI, so CSI palletizing. Um, uh, not not quite as popular as the other CSIs, but anyway, that's recent acquisition. It was supposed to be transformational. Um, According to what this was going to do for the business, and it's this idea that MPAC had to build a production line. They had sort of parts A, C, and D, and adding in CSI added part B. So it was the materials handling element, and particularly around palletizing, I think was the bit that they were missing. They had nothing that would do that for customers. So if a customer came to you and said, "Hey, I want to build a production line and I need this, 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 and this, and this," you'd be like, "Okay, well, I can give you 75% of it, but I can't do the whole thing because we don't have the expertise." Now they do have the expertise, so there's a bit of a. I mean, I kind of get it, but at the same time, I mean, there were some pretty crazy revenue growth forecasts that I looked at. I was like, well, where's that going to come from? Like, what, what, what's the basis that that's suddenly going to change in growth? So anyway, I was a little bit skeptical, and didn't buy this a year ago, despite looking at it. Actually, I mean, I did look at it and think it's too expensive. Um, just was a bit, I liked the idea of what they did and what they could achieve, but it was one of those where I thought, you know what, sit on the sideline. So as I've seen it drop and drop and drop this year, I mean, it hasn't been front of mind because I've had other things in my mind, but when I sort of looked at this, especially when I saw the first half 2025 results, I thought, wow, yeah, okay, right, like this is now time to really roll up your sleeves and get deep dive into it. So anyway, couple of other things they're doing that I would say are worth calling out, that it's not just about having that end to end, like, can I physically do all the stuff? But the other thing that they're doing is wrapping around more and more services. So kind of one of the cool things with this Siga vision is the idea that you can add sort of eyes to your production line and then sort of add AI, and the AI will kind of look at, I don't know, the things going down the the um the line, and if like sometimes machines can glitch up, can't they, and like it jams and it all starts building up, and they're like, like in Gold Rush, and somebody goes, like it's blocked up, and they all run for the off button, like, and the off button's like 30 seconds away, and they're all racing for it, like, oh, push the button. It's like, why do you guys not have like a remote control? I mean, surely in this day and age, you could just have like a thing where you could just push a button on a gadget that you're holding that will kill the power to the. Like, I never got that. And I don't know if they just literally do that for show in that program, and they have got the little gadget and they switch it off. But then they say, "Oh, let's do a little sketch where you're racing to that button to provide a bit of drama to the viewers." I wonder if that's actually the case, because it just baffles me that these Gold Rush people are like, you know, sort of like, "Oh, run for the button." Anyway, like, this is a case of don't run for the button. You don't need to. The AI will just oh, okay, it's going to jam. Let's let's realign the thing, or let's do what we need to do, or let's just shut it down. Like, but then it's the idea that it will self-correct itself. Uh, so it makes the machine, more productive. Ultimately, it's also the case you then don't need lots and lots of sort of engineers and people twiddling and tweaking it and monitoring it. It'll monitor itself. Now, obviously, that kind of is bad news for Charlie and the Chocolate Factory's dad, who perhaps wouldn't have got it was a toothpaste factory. I seem to remember it was a toothpaste factory. Maybe I'm wrong on that, but Roald Dahl fans can correct me on that one. Uh, put it in the comments below. Anyway, yeah. So Charlie and the Chocolate Factory's dad wouldn't get a job in the factory after he gets replaced by a robot, because the robot now can look after itself. Thank you very much. Um, but that's quite a big deal, I think. I mean, and I'm not saying MPAC are the only one doing that. It's unique to them. I'm not saying that, but they are one of the ones that are doing that. That obviously is a next generation evolution. That you can add a lot of things around what you're selling to make it more robust. Self-healing, I think, is one of the terms that they would use. They've won Red Dot Designs in 2025. I thought that was quite impressive. For Obviously, that's quite a high accolade within design circles. The Red Dot Design Award is kind of one of the real big impressive ones. Anyway, so if we go back and look at performance in 2022, 2023, 2024, you do see double-digit growth. And again, I can sort of see why people say, "Oh yeah, well, if it keeps doing what it's doing there, um, it would sort of continue to improve and go up in price." I don't get how it would sort of suddenly double accelerate. It's like I didn't get where the acceleration was going to be coming from. Um, and the CSI acquisition, which was I think 49 million. I mean, uh, they bought a business at 8 times earnings, 8 times EBITDA earnings. It's I mean, it's not mega cheap, but it's pretty cheap. And obviously you're buying know-how in that as well. I mean, that's the other thing, is that, like, this is sort of stuff where as you grow your volumes, that you leverage your profitability. So 8 times isn't perhaps the ultimate end, sort of maximum profitability. Um, but yeah, ultimately, like the way I've looked at this, rightly or wrongly, is to say, well, on a statutory basis, we'll look at the numbers in a second, and on a statutory basis, the numbers are going up. But on an adjusted basis, and what I'm adjusting by is, well, the fact is that shareholders got diluted by 42%. So really, what you need to do to compare performance in 2024 versus 2025 is drop the numbers by 42% to get an adjusted number. That's what I've done, and you'll see the results of that in a second. Um, yeah, and I suppose what I'd particularly call out was a year ago that you could sort of like Biden had lost, Trump had won. Trump hadn't taken power, but Trump was talking about tariffs. I wrote about Trump talking about tariffs back in sort of December and November, where it's very much part of his game plan. And anyway, but also that Trump promised to cut red tape. I mean, there was sort of the negative of the tariffs and the positive of the the, the red tape changes and the tax reforms. Um, so yeah, and I suppose a couple of other things I'd call out was Mr. Scott reviewed it, said it was erratic in terms of performance, but from my point of view, erratic is, these are capital goods and they have cycles and lumpy sales. That's the nature of the beast. If I think that's just yeah, that's the nature of the beast. The bit that I was interested in looking at is, are the services erratic? Because the services are the wraparound, the recurring, Are those growing? Are those erratic as well? You know, the equipment side, I can get that that would be erratic, but the service side, well, that would worry me if it were that were erratic, but it's not. I'll show you that in a minute, but it's not. And I'd also sort of, you know, the other thing pointed out was this high level of debtors. Well, yeah, but again, you know, if you're making something where it's, you know, essentially WIP for 9 months, 6 months, 9 months. I mean, they don't say precisely how long these things take to build, but I'd imagine that you know, again, just sort of thinking about, you know, factories take 2.5 to 3 years to build. Like, you know, you've got all the commissioning and whatnot. I mean, I wouldn't be at all surprised if an implementation cycle's around 6 to 9 months, possibly a bit more. So, you know, you are going to have people that you've contracted with that, I mean, these are big customers as well that are going to be like, well, you know, you get 60-day terms and we'll pay you once you've built it, basically, you know. So, like, you wouldn't expect to kind of expect, you know, global giants like Nestle and Pfizer and all of these to be like, oh yeah, of course we'll pay you up front, and yeah, of course, you know, like no problem, like we'll pay you on 0-day terms. Like, no, that's not how big companies are. So you've got to sort of be happy with that. But the thing that I suppose I also looked at was I said, well, okay, debtors are quite high, well, very high relative to sales. I get that, but it is about, you know, the equivalent to about 9 months of revenue, which fits my 9 month timeline. But also that creditors are equally as high. I mean, if you had huge high levels of debtors, and I remember, oh, what was that Simon Thompson idea? Anexo. Anexo had really high debtors. And I remember Mr. Scott calling out that and saying, "Oh, you know, they, like the thing is, they never collect the money. They've got all these receivables, and if you strip that out, they're not, you know, like the book value of it just plummets, and the business potentially is not worth anything like it's worth on paper because it's like how much of it is collectible, how much of those receivables can you actually receive. I think with this, I mean, there's just no bad debt that I could see. There's no sort of yeah, you know, it's not the same thing, but also that in the case of Anexo, the creditors were nowhere as big as the debtors, whereas with this, creditors are about the same size. So I felt quite relaxed about the fact it has high debtors because it has high creditors. You know, it takes 9 months. The customers don't pay you until you make it, until you build it, or at least, you know, maybe they do some sort of whip release, and you know, like, oh, we're halfway there, living on a prayer. You know, we'll give you half the money. So maybe it's 4 months, you get half the money, and 9 months, you get the rest of the money. But you know, whoever your creditors are that are supporting that working capital, I mean, they're not getting paid until that 4 months, 9 months, or whatever either, by the looks of things. So I feel quite relaxed about that. Huge synergies were expected. They were gonna cross sell. They were gonna do you know. So is there huge amounts of evidence to that? Well, not masses. There is some, but you know, not in the numbers themselves. It's more in the qualitative descriptions of what's going on in the business. We'll talk about that in a minute. If you look at the CSI performance and there's the revenue growth before they acquired it, it in some ways has disappointed. It hasn't sort of continued growing at 20-30%. So, you know, again, a little bit of high expectations set for what the synergies. You know, I can't sort of say hand on heart, oh yeah, since they've acquired it, you know, not only has it grown by the 20% it was growing at before, it's grown by more than that because of synergies. Well, no, you don't see those in the numbers. Although what you've got to sort of consider is the whole sort of uncertainty thing of Trump and tariffs and businesses kind of putting back their decision to invest in a new factory or whatever until 2026, there was, in MPAC's presentation, they say, well, just there's some customers that have said, look, you know, it's not going to happen in 2025. We're going to revisit this in 2026. So like we're just going to push it, kick the can down the road for a year, and that's it. So that's kind of what's happened. But it's if we kind of get into the detail of this, um, I mean, historically, CSI achieved about 37 million per half year, and they were growing 20%. So you'd expect sort of 44 million, but you don't get 44 million, you get 26 million. So this is kind of what I'm saying of, like, I'm not going to dress this up to be something it's not. And CSI doesn't achieve as much as you'd maybe think or expect or hope. So, when you say, oh, you've paid 8 times earnings, well, based on 26 million of orders in first half of 2025, well, that's more like, probably more like 11, 12 times earnings or something. It's not, you can see it's over half, but it's about 60% of where it should be. But what we also see is that the 2024 acquisitions achieved 36 million of revenue, and that is actually on a par with what they achieved the year before. So in other words, back when the share price was double, the underlying business is still achieving the same as it did before. The thing I would particularly call out is essentially that when you look at it, the comparative, when you factor in what it sort of should achieve, um, versus what it did achieve. I mean, you're looking at something like BSA's dropped by about 15%. Now these guys are in America, so it's not a great surprise that they dropped. CSI, some of what they were doing was in America. They're based in Europe, but they were selling into America. So there's kind of quite a few things where you sort of say, well, okay, yeah, there definitely has been some level of disappointment with these acquisitions so far. But then what you've also got to look at is some other stuff. So order intake 64 million, and that included 25 million of CSI. So again, this expectation of an order intake of 44, well, the order intake was actually 25. So um, revenue was 26, of sort of order revenue, if you follow me, but 25 of order intake, so future order book. Uh, the um, the pre-acquisition business is achieved an order intake of 31 million, um, and of that was 6.4 million in the Americas. So what I point out. Oh, sorry. No, sorry. 37.7 was the underlying business order intake. 31.3 of that was Europe, and 6 was Americas. Now, historically, that was about 60-40 US, North America versus Europe. So in other words, if you actually take, well, that number there and then add 50% to it, so we should be seeing something like 46.4 million, not 6.4 million. So what that implies is, if it's true that the customers have deferred their orders to 2026 or later in 2025, then what you're not seeing in the order intake, in the order book, uh, is 40 million pounds worth of sales or of orders, of future orders. If that's true, and I'm not sort of saying it's definitively true, but taking the evidence of what we're being presented, that's the implication here. uh, then really the order book at the end of June, which was 91 million, 91.7 million, which in itself was higher than a year ago at 77 million. So the order book has increased, not decreased, which is a positive. Obviously, part of that though is the CSI acquisitions have added to the order book. So on a like for like basis, it's not a bigger order book; it's a smaller order book. but on an absolute basis, it's a larger order book. And the order book was 118 back at the end of 2024. So it's larger than 12 months ago, smaller than 6 months ago. But if you factor in that 40 million of hidden, like of order book that isn't there but will be there, that's deferred, well, the real order book would therefore be 131, and that's grown from 118. So on that basis, you can start to get quite excited about this, that the pre-acquisition and the post-acquisition has led to a genuine increase in orders, if you believe the question of it being deferred. Now, you might not. You might say, no, that's a load of cobblers. That's just nonsense. I mean, where I'm getting all of those numbers from is the presentation deck, and we can see there the 6.4, which was US, and the rest of the world 57. But then here we can see, this is where we've got our sort of order intake split and our order book. So we can kind of get to the numbers by sort of looking at the various metrics that they share with us. But even if you say, well, look, like half of that is just not real, half of it's, they've that gone, they're not coming back. I mean, you still get to 113 million order book, which is a shade under what it was at the end of 2024. In other words, it that order book there is at least 25% higher run rate than their run rate performance in the first half of 2025, and that's a very encouraging idea. I mean, that order book, if they achieve that that's about 9 months of work, but or 9 months of revenue at historical levels. But if they increase their rate of work, because obviously people are not going to sort of particularly want to wait longer, that's nowhere in the price. So anyway, let's kind of get into this a little bit more. So what I did was I took the order intakes going back to 2022. So again, you can sort of see an increase there. Order, so original equipment revenue, service revenue. So we can see growing recurring revenue. This was the bit that I was worried about being erratic, but well, I mean, okay, yeah, we do see a spike here that drops back here, uh, but really, what we see in there, apart from this little spike here for whatever reason, is a steadily growing recurring revenue of service revenue. I'm happy with that. I mean, and obviously that is good. We'll look at the margins in a second, but that's kind of a real key number for me. Obviously, this one you can sort of see. Yes, there are some lumps. It goes down and then it goes up and then it goes down and then it goes up. But I mean, this number's not vastly awful, like compared to that number, I mean, obviously here the share price was double of what it is here. Now, obviously, this does include the CSI stuff, but even so, it's not a vastly terrible number in terms of the revenue, and not a terrible number in terms of the order intake. So, um, you could say, well, when you factor in CSI, it's a 37% weaker performance in the original MPAC business, in the pre-acquisition companies. But really, the whole thing is stronger by about 7%. So the 42% dilution means that it's 35% weaker, really, on an underlying basis, on a run rate basis. Yeah, but I suppose I'm looking at it saying to myself, well, hang on, okay, the, obviously, if you're an existing shareholder, you've been diluted, boo-hoo, you've lost money. But as a new shareholder, I'm looking at this going, well, it's this much weaker performance, but it's dropped by this much in 2025. So really, pro rata, I mean, it's 12% stronger than it was before, even after taking into consideration dilution and weakness and so on. And obviously, that number doesn't include anything of that 40 million of potentially deferred order book, none of that is in the price. So I kind of like that, and I put those into numbers. I mean, what I'm seeing is order intake growing. I'm seeing obviously some, as I say, some variation to original equipment orders, but I'm sort of seeing a more or less growing, or at least steady level of activity. I'm seeing growing services. I like that. If that can go up and if that can actually accelerate, that would be a good thing. Also, the order book, that equals about 9 months of revenue. So there's a certain level of safety that you could say is built into this. Declines have been arrested in Q3, we're told. It's now in line. So, they say it's in line with revised expectations. I don't think we know specifically what the revised expectations are, but they're in line with them. Um, so, um, there's lots of things to say we're at the turning of the tide. And also that, even taking into consideration the dilution from additional shares being issued and debt being taken on, and the cost of those acquisitions, there's also offsetting that is the drop in price. So you've got to sort of look at it from both. Do we see synergies creeping through? Not in the numbers themselves, as I've said, but like this, I thought was a massive plus. I mean, nowhere is this in the price. That if we say, well, 42% of all original equipment orders were new customers to the group. I mean, like, think of all the cross-sell, upsell, service opportunities that we're going to enjoy from these new customers. Like if this was like zero, that would be very worrying, because it's like, well, at what point does the music start to stop? Like, whereas what they're actually saying is, well, yeah, we're actually, like, yes, a lot of our customers have said, sorry, we're going to defer to 2026. Well, they've gone out and got new customers. That's what I'd do as well. I mean, that's good business. So, fair play to them. Obviously, really good names, high profile names, global names, but these are large customers with lots of power. And so little MPAC with its little, sort of, powerful customers. So the sort of five forces model to this is a negative, but at the same time, I mean, these are, there's a lot going on in the world of uh, medicine and healthcare and products around that, around food and innovation in food. So these themselves are either steady or growing businesses, and businesses that are ultra focused on productivity and driving more and further productivity. I mean, you look at PepsiCo's long-term track record of productivity is tremendous. So a company like MPAC are going to be, PepsiCo are going to be all over what they can do to help them. They're going to be very, and I'm just calling out those because that's one that I've looked at. But I mean, no different for Kellogg's, Nestle, Diageo, Procter and Gamble, Mondelez. I mean, these are Mars is vast. All of these companies are really, really focused in on driving efficiency, and MPAC can help with that. So, yeah, strategic accounts, 42% of new customers, 41 different customers. A lot to be said for the advantages there. Also, that there were restructuring costs in 2025 H1, but they've relocated a lot of production and sub-assembly to lower. Oh, here we go. We've got the gremlin thing. See if I can arrest. Oh, it's so annoying when it does this, and I don't know how to stop it. I might have to just wait for it to decide to stop and then rewind. Very, very, very annoying. But you do get to see the rest of the article. Maybe I should sort of talk very, very fast, and then you'd see the whole thing. But there we go. The surprise is all being spoiled. I probably do need to speed up anyway because we are at 40 minutes and uh, uh, um, oh, come on, you stupid web page. Right, here we go. Take back control. Come on. Oh, come on. As I say, I'm sure it's something to do with the antivirus that. Oh, there we go. Very annoying. Very. There we go. We were here. So anyway, let's do speed up. Yeah. So lower cost operations. So that should feed through to gross profits. In any case, gross profits by period, again, what I was very, very pleased to see was gross profit growing, particularly for the recurring, but also for the original equipment. So you can sort of see when you actually look at it from a gross profit point of view. I mean, uh, for for a share whose price has halved, I mean, you're getting, double gross profits approximately, um, compared to 2024. So that's pretty impressive. Now, what I said to myself was, well, hang on a minute, compare like for like, 42% adjustment, so 42% dilution. If I only include 58% of this number, what you see then is with that, sort of kneecapped, uh, you can see it's still decent. I mean, it's still overall, service revenue is solid compared to past. So this is sort of, you could call this the underlying business, maybe. Um, it's not a terrible result. I mean, yes, the blue bit, the equipment, is down slightly. It's certainly not accelerating, but this is pretty solid compared to the previous 2 years of data, and obviously far ahead of 3 to 4 years back. So I kind of looked at that and said, well, even if you strip out 42%, you're still getting good numbers if we look at it from a margin analysis as well. So gross profit margin back here was sort of 30% for the services and 20% for original equipment. I mean, you look at 1H25, I mean, the margins are vastly improved, vastly improved. I mean, look at those. Those margins are quite exciting. I mean, 66% for services and 41%, I think it was. And again, even if you strip out the 42%, which is a bit weird, I mean, because obviously the margin's the margin, but let's do it just to sort of say, does that kneecap it? Well, no, not really. I mean, yes, services margin pro rata is down, but I think this, taking a percentage off the margin is not actually a fair comparison because taking off volume rather than percentage of, you see, like, I don't know if that makes sense, but like, they're not less profitable because they made acquisitions. That, well, they're less profitable in terms of before they made the acquisitions, they had fewer shares, but they had fewer sales. They've got more sales, but the margins they were making were pretty, so I might even remove this chart because it's not really accurate or fair to say that the margin has dropped by this much. This is the margin. I suppose the only thing you could say is, well, this margin includes the CSI margin, and obviously there's no real way of stripping that out because we don't know what the split is. But anyway, yeah, if you can sell things to people at a 66% gross margin for services and 42% for equipment, I mean, you've got the opportunity to ratchet profits. Now, looking at the broker sort of models, they sort of talk much more in terms of, oh, well, we'll just sell more stuff, lots more stuff at the same margin. But for me, when I look at this, the story is far more about a growing margin and ways in which they can achieve a higher margin business to grow profits appears to me to be the way forwards. And so, this growth of sales of 230 million by next year, which was, I mean, this was a forecast made back in 2024 when they acquired the CSI business. Um, I don't see that that is particularly happening or going to happen or could happen. I don't think it's about growing the volume. I think it's about growing the quality, and that's what I can see MPAC doing. Anyway, and those are the percentages. So that was the data you saw on the graph. But yeah, like playing devil's advocate and saying, well, okay, maybe not 230 million, but if they can get to 200 million, which is about, that's about 40% ahead of what their run rate is in 2025. But if you've got 40 million of deferred order book, if you've got an order book of 130-ish million, as long as you can refill it at about 100 million per half year, I mean, you are going to hit 200 million on that basis. So I don't think this is necessarily an impossible dream. And if we sort of say, 42% margin, so ignore the 66, let's just say the whole thing, the average of these is going to be 42. So there's quite a lot of safety built into that assumption. I mean, you get to 42% on 200 would be 84. If I say, the distribution costs, admin costs, so the things that strip it out to operating profit were 23 million underlying in 1H25. There were restructuring costs and other things, but ignoring those, so the underlying, even if I sort of grow that number from 23 to 25, so 50 per year, I mean, that gets me to 34 million operating profit, and obviously per half year that would be 17. Well, obviously you can sort of make your own view as to whether 2 million of extra would be, whether it need to be more than that. But they do say that they're going to achieve cost reductions through Romania, Malaysia. So is it totally unfair for it to be, this will be a 50 million number, not more? There's reasons to think that that could be the case. If that's the case, I mean, this is the bit where I fell off the chair. Well, we're saying then that operating profit, which was 7.5 million, and again, look at these numbers. I mean, the underlying operating profit in 1H25 was no different to 2H24, and it was nearly double of 1H24. And this is back when the share price was double of what it is today. So the operating profit you're getting per million or per pound of MPAC shares, I mean, it's about double. Compared to what you would pay back here, it was double. It is double today. And the underlying cash flow, again, another criticism that was made, I can't remember who said it, but one of the commentators said, oh, they don't make any cash. Well, that's not true. Again, what I've done here, and selective, but what I've done here is I've said, I'm not interested in working capital changes. I mean, obviously you've got to worry about working capital changes, but ultimately, like the way I see it is, as you grow, your working capital grows, and obviously it swallows cash. That's part of growing. But eventually, working capital doesn't swallow cash, it stabilizes. So I'm going to ignore working capital, and this is underlying. So again, it's ignoring restructuring fees and things that were one-offs. So I'm just interested in underlying. But if I go back over 7 periods, underlying cash flow, operating cash flow, is running at about 4.5 times of where it was back in 2022. So a vastly improved performance, and again, equal performance to here. I think that's I mean, but these numbers, if we can grow that operating profit number from 7.5 to 17, well, I mean, you're then looking at something that 17 would sort of then work out net profit. I think if you sort of strip that down, take tax off, take interest payments off. I mean, you get to something like and actually the other thing I did was just again for the if I take 42% off that number, I mean, you're still looking at a growing operating profit. So 58% of that number is still much higher than that number. So there's lots and lots of, so that's what I've done there is even if you strip out, or in fact, even if you do that for 1H25, I mean, it's still broadly, I mean, okay, it's not as high as this performance here, but it's still broadly comparable to what you were achieving prior to 2H24. And this is in a period of time when things were, not great. The order intake to America was not great. So again, there's a lot of, I mean, for the share price to have halved, um, that performance versus that performance, and this is kind of, as I say, taking off 42% of dilution. So as a shareholder, that's kind of what you're seeing. Um, and if we get to a sort of an 11 million net profit, that's per half year, by the way, that's 22 million a year. I mean, on a company whose market cap is what, 88 million, 87 million. I mean, it's less than four times earnings. And you can see here operating profit again, this is growing really substantially, and the red is the cash flow. Uh, what valuation should this go for? I mean, I would say today, even on the 1H25 numbers, you're looking at something like a 10 times underlying. Maybe I need to add that word in there to just be clear. I mean, I was saying the statutory performance is a PE of 10 times, but the underlying is 10 times. The other thing that they tell us is that they've sorted out their overhang of the pension. So, when this was anybody including this as an idea for 2025, I mean, they were taking a risk of this spectre of a pension liability. Well, they do say that 5 million of proceeds should become unrestricted. So that's 5 million that gets to go back into the business. So that's a positive, but it hasn't happened yet. Probably won't happen until 2027. So anyway, as you can tell, I quite like this. Well, I do very much like this share. I very much like the price that I'm paying for the share. If it was at £5, I wouldn't want to pay £5 for it, or at least I wouldn't have wanted to have paid £5 for it back when I looked at it in late 24. But to sort of look at it now in late 2025, when I mean, I think now the question of tariffs, because there's the tacky thing, or taco thing, the Americans call it taco, TACO, Trump always chickens out. I call it tacky because I think tacky Trump, Trump always caves in. I think that's the certainty that's come back into the business world now, that we know that, that America can talk a game of increasing or introducing tariffs, but then retracts when stared down by a trading partner. So I think we're now at a point where the fear of change and of tariffs, the fear has gone away. I think people have now got that in their stride. So when people revisit in 2026, right, what are we going to do? I think the thing that will be there in their mind is the OBBA, the One Big Beautiful Bill Act, OBBBA. And the reason I say that, and the reason I think that this is going to just end up being a real bumper year for MPAC, in other words, the 40 million of deferred order book will come roaring back, but then there'll be a whole load of other orders as well, is simply this, that the Americans have introduced through the One Big Beautiful Bill, which of course only came into law quite recently. I don't have the precise date, but I think it was September, August maybe, but I think it was September, when they actually agreed and finalised it. Consider what it means for MPAC's customers. So before, there was no certainty that they would be able to claim tax depreciation on the purchase. Now it's guaranteed, so guaranteed 100% year one for, and I've done this based upon conveyors and packaging machines. Before the One Big Beautiful Bill, they would be able to get some essentially recognition to offset this against tax. Now it's permanent and it's 100%. In other words, somebody spends 10 million with MPAC, that's 10 million they can basically offset against paying tax on profits. So there's a huge encouragement in 2026 when people revisit their plans to go ahead with their capital project. You know, the metrics, the calculation has fundamentally changed. Now, I was surprised it was as high as 60% because I understood it was a much longer time period. Uh, it's not an easy area, and it's not an area that I want to kind of delve into deeply, but this Macca's 7 year is kind of what my understanding was, is that you would pay 10 million and then you'll be able to recognize like 1 point, because what the Americans do, they'll do a recognition of depreciation, like this machine will last me 10 years, so I'm going to recognize 1 million of depreciation a year, and that 1 million of depreciation comes off your profit, and therefore your calculation of tax is 1 million less. But what the Americans do, and GAAP accounting does, that's a bit more complicated, is you might say, oh, well, that machine lasts 10 years and I'm going to depreciate it by 1 million a year. But then on a tax book basis, you might say, oh, well, the rule is, though, that I can depreciate that machine over 1 year. So um, even though let's say my operating profit's 10 million, and in that the depreciation is 1 million, so 11 million EBITDA, and 10 million EBIT. From a tax book point of view, the tax bill is based upon not 10 million, it's based on 1 million, because essentially it's the 11 million minus the full 10 million. You're only paying tax on 1 million of profits, which effectively brings the effective tax rate for USA down to about 12% effective rate. Now that 12%, I'm getting that from Kathy Wood and her monthly In the Know. In fact, I think she said it was below 12, maybe 11.5, something like that. But the effective rate for MPAC's customers of tax will be the reason that I believe MPAC will roar back in 2026. And I also sort of go on and say, well, look at the PMI, the manufacturing PMI, completely different to back here when orders were being deferred. You know, back here it was sort of, you know, 49, 50. Now it's at 52. It's in expansion territory. In fact, here it was at 53. So you know, it's 52.2 today. And I also talk about Germany. You know, people say, oh, well, you know, Germany's suffering a crisis and they're hollowing out their industry. Are they? Not according to, oh, I thought I'd included it. But yeah, I did the same thing, and the PMI index for Germany is 50. So it's up from 45, it's at 50. So the manufacturing PMI in Germany is no longer in contraction. It's not in expansion yet, but it's back to where it's back to neutral, in October. So things are heading in the right direction for MPAC. And you know, you could easily spend, because I covered this in my 3 different robotics articles, easily spend 20 times, 30 times, even more on a company like MPAC. So to be buying it at 10 times or below 10 times, where you can sort of see a pathway through where it could fall to 4 times, well, I think that's a huge bargain. I think that's completely overlooked. Now, do I think it'll grow to £8 a share or whatever? Don't know about that. But what I do know is that it's cheap at well, I mean, as I say, when I wrote this, it was £2.90. It's since gone up 25p. So is it cheap at 3.15? My view of it, I mean, you make your own investment decisions. None of this is investment advice, but from my point of view, when you look at comparables, and in fact, the other thing I do here is look at other companies like MPAC that were sold in the last 12 months. So these guys, Paxium, sold at 12.5 times earnings. This one, Alu FlexPack, I guess, 15.2 times earnings. So even if the growth that I'm sort of saying I think could happen doesn't happen, it's all flat. And you can sort of see it's even in a bad half year as it has been, it's not been that bad. It's steady. There's a certain level of, things can't get too bad because, or at least they haven't got too bad in all the years that they've been, all the years I looked at. So, um, there's some level of sort of downside protection to this as well, in the sense that, well, it's not ever managed to do a really horrendous performance. It's just questionable about whether uh, whether they are going to get caught out with order book. But the order book's heading the right way as far as I can see, and as the evidence goes. So, um, I mean, I've not talked about the 74.7 shareholders' equity. So, the balance sheet on paper, you're paying like just over 1 times its book value. But because pretty much all of this is in intangibles, and when I'm talking about the underlying numbers in this article, I am sort of, one of the things that makes it underlying is they're ignoring the amortization. So I do sort of, I don't like to sort of hoodwink but I sort of say here slightly sarcastically, intangibles remain at their same value forever. Not uh, in the sense that, well, I do appreciate that I'm essentially saying, oh, well, there are no costs to the intangibles when doing my underlying calculations. I think that's fair enough if I then don't say, well, these assets are worth something. So I'm not saying that. I'm saying, don't judge this by its assets or its balance sheet. Judge it by its future expansion of profit, its know-how, its run rate of service revenue and service profit, which is substantial. And so that's the basis for the valuation, and also the comparative to other companies in the same space. There is a lot of consolidation going on in this space. Will MPAC get bought out is another thought. It's not impossible to think that might happen. I'm not assuming it's going to happen, but yeah, as far as I'm concerned, because it's got 107 million of intangibles, then the 74 million of shareholders' equity, I mean, just I say poof, zero. I'm not assuming that that's actually worth anything. I think the other final thing, I'm sorry, I am over an hour now, so I do apologize, but um, a number of directors have bought shares, and quite large, six-figure amounts of shares. Have they done the same maths that I've done, or do they just like bowls? I don't know the answer to that. But I do notice as well, Fidelity, Schroders, Gresham House are all buying MPAC. They've increased their holdings, where a lot of these IIs are shedding shares. They're not shedding them here. Again, I took that as a bullish signal, um, uh, or at least another validation to my own mathematics. And this is the bowl. So I think you sort of see it slightly here, and you can see it more clearly in this 3-month chart of the share price. So that's the bowl, and where will the bowl head? I don't know, but you can sort of see, if that's a big part of a bowl over here, then I don't know. Maybe it will double from here. So we'll see. Anyway, none of this is advice. This is just me saying, uh, look at the margins, look at the prospects, look at the new customers, look at the one big beautiful bill, look at the deferred, potentially 40 million of deferred order book that will potentially roar back in 2026. So I guess, here we are at the end of the article. Is this going to be one of my picks for 26? I sort of ummed and ahed a little bit, but really I was like, well, it can't not be really, when I really like where I think it's gonna go. It feels like a good, solid business and quite exciting. So yes, it's part of the Oak Bloke picks for 26. So that's enough from me. Oak Bloke signing off. This article will be published in the next couple of days, but you're the first to enjoy it here on YouTube. And have a good day. Cheerio for now. Cheerio.